I've shared with you some tax planning strategies that require a little bit more planning and implementation, but today I want to share with you 5 items that you still need to consider that don't require quite as much planning, but you need to consider prior to year end. The use of the Section 179 deduction. If you're remodeling or planning large purchases or purchasing equipment, make sure that you're utilizing the Section 179 appropriately and consider even prorating the 179 deduction over a 2-year period depending on how much equipment that you may be purchasing. Consider paying your children from your business. If your children have been employed and done work in your practice or can do work between now and year end, make sure that you pay your children an appropriate salary and then consider using that salary to fund a Roth IRA or maybe a college savings plan for your child. If you rent your own building or you own your own building, make sure that your CPA is correctly coding your building on your personal tax return so that it's not subject to the 3.8% Medicare surtax. While rents from third parties in your building are subject to the 3.8%, the profit on the rents that you pay yourself for your share of the building are not subject to the 3.8% Medicare surtax. Make sure that you're meeting with your CPA and pay your state income taxes prior to December 31st. While your federal income taxes are not a tax deduction, your state income taxes are a tax deduction on your federal income tax return. Meet with your CPA or your advisor and make sure that if you do owe taxes for state and it's appropriate, pay them by December 31st to claim that deduction on your 2016 tax return. Fund your Roth IRA. Depending on your income limits, you can fund your Roth IRA directly, or if your income limit is too high to fund a Roth IRA directly, consider the backdoor funding of the Roth IRA, where you fund a traditional IRA and then convert to a Roth IRA with very little or no tax. By doing this, you are getting income that you would be saving after tax, creating interest and dividends and capital gains for your future, and eliminating those when all of your withdrawals occur from the Roth IRA. These are just a few items to think of that can help not only your tax savings, but also your long-term planning that you look at prior to year end.